Classical Accountancy Numerical Problem Solutions, presented by NCERT.com. In this video, we are going to provide reconstitution of a partnership firm, retirement or death of a partner, problem 2 solution. The problem statement is as follows. Sangeeta, Saroj and Shanti are partners, sharing profits in the ratio of 2:3:5. Goodwill is appearing in the books at a value of 60,000 rupees. Sangeeta retires and goodwill is valued at 90,000 rupees. Saroj and Shanti decided to share future profits equally. Record necessary journal entries. So, it is given in the problem that the goodwill is appearing in the books at a value of 60,000 rupees. It is also given that after the partner Sangeeta has retired, the goodwill is valued at 90,000 rupees. Considering this, we need to record the necessary journal entries. It is also given that the profit sharing ratio in the old firm was 2:3:5, and in the new firm, the remaining partners Saroj and Shanti shared the profits equally. In other words, they were sharing the profits in the ratio 1:1. Here, we need to consider the accounting treatment of two types of goodwill. We need to write off the goodwill appearing in the books. And then, for the goodwill of the firm, the remaining partners should contribute to the retiring partner's goodwill share. Let's first deal with the writing off of the goodwill appearing in the books. Just to remind you, this means that we need to write off the goodwill for all the partners in their old profit sharing ratio. Now, for partner Sangeeta, this is equal to the total goodwill appearing in the books, which is 60,000 rupees multiplied with her profit sharing proportion 2/10. Let's cancel the 0 in 10 for a 0 in 60,000 rupees. Now, if we multiply the remaining 6,000 rupees and 2, we get 12,000 rupees. This is the amount of goodwill that need to be written off from partner Sangeeta's capital account. Now, for partner Saroj, this is equal to the total goodwill appearing in the books, which is 60,000 rupees multiplied with his profit sharing proportion 3/10. Let's cancel the 0 in 10 for a 0 in 60,000 rupees. Now, if we multiply the remaining 6,000 rupees and 3, we get 18,000 rupees. This is the amount of goodwill that need to be written off from partner Saroj's capital account. Now, for partner Shanti, this is equal to the total goodwill appearing in the books, which is 60,000 rupees multiplied with her profit sharing proportion 5/10. Let's cancel the 0 in 10 for a 0 in 60,000 rupees. Now, if we multiply the remaining 6,000 rupees and 5, we get 30,000 rupees. This is the amount of goodwill that need to be written off from partner Shanti's capital account. Now, to proceed with the accounting treatment to write off the goodwill account should be created with the total goodwill amount appearing in the books, which is 60,000 rupees. And partner Sangeeta's capital account should be debited with her goodwill share of 12,000 rupees. And partner Saroj's capital account should be debited with his goodwill share of 18,000 rupees. And partner Shanti's capital account should be debited with her goodwill share of 30,000 rupees. Let's now proceed to journalize this transaction. Let's first write the journal header. Let's then have the rest of the journal format. Now, let's first write the partner Sangeeta's capital account as the debit entry. Let's also write the text DR to indicate that this is a debit entry. Let's then write the debit amount of 12,000 rupees in the debit amount column. Let's then write the partner Saroj's capital account as the next debit entry. Let's then write the text DR to indicate that this is also a debit entry. Let's then write the debit amount of 18,000 rupees in the debit amount column. Let's then write the partner Shanti's capital account as the next debit entry. Let's then write the text DR to indicate that this is also a debit entry. Let's then write the debit amount of 30,000 rupees in the debit amount column. Leaving some margin, let's write the goodwill account as the credit entry. As you know, the credit entries start with 2. Let's then write the credit amount of 60,000 rupees in the credit amount column. Let's then write the description or narration of this transaction as being goodwill appearing in the books written off. Let's then draw a line to mark the completion of journalizing of this transaction. With that, we have completed the journalizing of this transaction. Let's now proceed with further analysis. Just now, we have completed the writing off of the goodwill that is appearing in the books. Now, we need to proceed with the firm's goodwill, which is valued at 90,000 rupees, and calculate how the remaining partners should contribute to the retiring partner's goodwill share. As you know, the remaining partners contribute to the goodwill share of the retiring partner in their gaining ratio. But the gaining ratio is not given in the problem. So, let's find the gain in share, which can be calculated by finding the difference between the new share value and the old share value. From this, we can find the gaining ratio. Also, just to remind you, the old profit sharing ratio was 2:3:5 and the new profit sharing ratio is 1:1. Now, for the remaining partner Saroj, the gain in share is equal to his new share proportion of 1/2 minus his old share proportion 3/10. Considering 10 as LCM, the numerator will have 1 5s are minus 3 1s are. This is equal to 5 minus 3 whole upon 10. This is equal to 2/10. Cancelling with 2, 2 1s are, 2 5s are. This is equal to 1/5. For the remaining partner Shanti, this is equal to her new share proportion of 1/2 minus her old share proportion 5/10. Cancelling the second fraction with 5, 5 1s are, 5 2s are. This is equal to 1/2 minus 1/2. This is equal to 0. So the gaining ratio of the remaining partners is 1/5 is to 0. After simplification, this will become 1 is to 0. In other words, this means that the entire goodwill share of the retiring partner Sangeeta should be contributed by the remaining partner Saroj. As the remaining partner Shanti's gain in share is 0, she doesn't have to contribute anything. So the share in the goodwill of the firm for the retiring partner Sangeeta is equal to the total goodwill of the firm, which is 90,000 rupees multiplied with her profit sharing proportion 2/10. Let's cancel the 0 in 10 for 1 0 in 90,000 rupees. Now, if we multiply the remaining 9,000 rupees and 2, we get 18,000 rupees. This is the share of the retiring partner Sangeeta in the goodwill of the firm. Now, to distribute this goodwill share to the retiring partner Sangeeta, her capital account should be created with 18,000 rupees. And as we have already seen from the gaining ratio, all this share should be contributed by the remaining partner Saroj. So, partner Saroj's capital account should be debited with 18,000 rupees. With this analysis at our disposal, let's now proceed to generalize this transaction. Let's first write the partner Saroj's capital account as the debit entry. Let's also write the text DR to indicate that this is a debit entry. Let's then write the debit amount of 18,000 rupees in the debit amount column. Let's then write the partner Sangeeta's capital account as the credit entry. Let's then write the credit amount of 18,000 rupees in the credit amount column. Let's then write the description or narration of this transaction as being Sangeeta's share of goodwill adjusted to Saroj's capital account in his gaining ratio. With that, we have completed the generalizing of this transaction. And with that, we come to the end of the solution to this problem. Thanks for watching.
Edixit.com is started to promote effective and efficient learning process to help the students with their learning requirements. To watch all our videos, please subscribe to our channel. Also, please click on the bell icon to receive a notification as soon as a new video is published. Please click on the like button if you like this video. Thanks for watching.